Hi guys, welcome back. This is Thomas. Better mindset, better life. In the past 2 months, as the virus outbreak turned into a global threat, the Dow Jones index, which represents the US market, dropped 12% within less than a week. Other areas, such as the Canadian market, dropped 8% as well. With such volatility in the market, how can we get a good rate of return without any investment knowledge? Today, I want to share 3 simple yet very effective strategies. If this is your first time here, my name is Thomas C. Chen, and this channel is about financial growth by sharing knowledge, habits, and mentality. If you like my videos, make sure you give me a thumbs up, subscribe, and hit the bell so you won't miss any important information. Strategy number 1, diversification. There's always a say, don't put all the eggs into one basket. Question is, how many baskets do you have? There are 2 ways to look at it. One is market diversification. If you are investing in the market, where do you invest now? This chart indicates how each sector performs in the past 5 years. As you can see, there's no such thing as a bad sector. One sector might have the lowest performance in 1 year, but it could turn into the best performance in the following year. So the question is, how diversified is your portfolio? Also, experienced investors such as Warren Buffett does not chase the market or put everything into hot stocks such as Amazon, Apple, or Tesla. His main portfolio is always well diversified, 40% in the finance sector, 30% in the IT, 15% in consumer staple, and rest in healthcare and energy. The second part is asset diversification. What kind of assets do you have in the entire investment portfolio? Is everything in equity-based or market-related? Even you have shares from different sectors, but it's still considered as one asset, the paper asset. Please note, in order to be truly diversified in your portfolio, you want to have at least 3 to 4 different types of assets such as cash, fixed income, real estate, and commodity. Strategy number 2, discipline. The basic rule of thumb for investment is buy low and sell high. But how many of us can truly do that? When the market is hot, lots of investors want to chase the investment return. And when the market is down, people always try to time the bottom, and 99% of the time it doesn't work. Research shows if you invest $10,000 20 years ago, today you will have close to $30,000 or 5.6% per year. If one missed the top 10 best days in the stock market, the overall return was cut in half. What's worse, it will go into the negative return if one missed 20 best days. Peter Lynch, one of the legendary mutual fund managers in history, one of the funds that he managed between 1977 to 1990 had an annual return of 29%, twice the return compared to the US index. And his word is simple. The price at which you bought was not important. The key is how long you held. In my previous videos, it's always better to set short-term, mid-term, and long-term goals first, then find a suitable investment vehicle to pair. Remember, the time in the market is far better than timing the market. Strategy number 3, dollar cost average. Imagine there's an airline stock and the stock worth $10 per share in January. In February, there were problems found in the plane and then the stock dropped to $5 per share. In March, more problem was found and market share now drops to $2. And in the following month, there was a mysterious virus and everyone scared to travel and the stock dropped to rock bottom, to $1 per share. In May, both the virus and plane issues were solved, so the stock went back to $5 per share. John and Tom both invest $10,000 into this airline stock in January and sell at the same time in May. The only difference is John invests in a lump sum of $10,000 in January, and therefore he lost $5,000 in June. Versus Tom wants to reduce his risk and divide his money into 5 pieces equally. He invests $2,000 each month for 5 months straight. So in January, the $2,000 get him 200 shares. February, 400 shares. March, 1,000 shares. April, 2,000 shares. And May, 400 shares. In June, Tom has 4,000 units in total and sell at a price of $5. He gained $10,000 instead of losing $5,000. Same time frame, but different results. The nutshell is to invest equal amounts of money at set intervals. It can be done daily, weekly, bi-weekly, monthly. It is a great way to invest, especially during volatile markets. Also, it takes away the emotional factors out of the investment decisions, which is the key part of being disciplined. So here you go. Don't put all the eggs in one basket. The time in the market is far better than timing the market. And when in doubt, do dollar cost average. This has been always my investment strategies, and I hope it helps yours as well. What is your strategy to invest? Please comment and share below. And as always, thank you so much for spending the time with me. If you like my videos, make sure to give me a thumbs up, subscribe, and hit the bell. And I will see you in the next videos.